All right, welcome everyone to tonight's presentation. It looks like there might be a few more folks that log in as we begin tonight based on the number of participants that signed up. But that said, we always upload our webinars to our YouTube channel, which you can easily find at Kappel Realty Group. Just type that into YouTube and you'll be able to find both this webinar and many other webinars that we've hosted, including those on free down payment assistance money that you can get if you're a first-time home buyer, as well as webinars that cover investing in real estate, investing in 2 to 4 units, house hacking, and many other topics. Tonight's webinar, San Diego Real Estate and Economic Update, is kind of our flagship webinar that we do every single month to provide you with an update on what is going on in today's economy, and importantly, today's real estate market. As you can imagine, things move, but they don't move drastically every month, yet they move enough that it's worth doing a monthly webinar to keep you guys educated on what's going on in the real estate market. So with that, I'd like to start with a quick introduction of myself. For those of you, maybe it's your first time on, my name is Patrick Kappel. I am the team leader and CEO of the Kappel Realty Group, one of the top real estate brokerage firms in the United States. We've sold nearly $500 million in real estate in just the last 5 years, and we regularly sell over $100 million in real estate, where we're based out of here in San Diego, Southern California. I have a little over 15 years of real estate experience, and I started out while I was a young guy in the Navy. In between my military deployments, I would buy real estate. One of my mentors when I was in my 20s said, Patrick, after every deployment, save your money and buy real estate. So before the age of 40, well, still in my 30s, I amassed a small portfolio of San Diego real estate, over 8 properties within our region. And I transitioned from the Navy into real estate, where I now run my team. During that transition, I used a GI Bill to get a couple of master's degrees, including a Master's of Science in Real Estate at the University of San Diego, an MBA at UCLA, and before the 2 graduate degrees, I went to U.S. Naval Academy for the undergrad. You see all the awards there on the right. Our team consists of real estate agents, about a dozen of us, that are all highly educated in real estate, and 100% of our team members own real estate in the San Diego region. So I like to say we practice what we preach. And although I and my team work in real estate brokerage, which at the end of the day is real estate sales, we always approach our business through education. And I tell my agents and everyone within my team every day that our job is not to sell real estate, is to educate consumers. Because I believe if you are fully educated on all the benefits of real estate, it will sell itself. And that's why we do these webinars, to educate you and everyone else out there who's a consumer of real estate or who's just interested in real estate, because I believe being educated in anything is the most powerful tool you can have when making decisions, including the decision to buy or sell real estate. So with that, you can see a photo of our team here. If you have any questions after tonight's webinar, or if you'd like to reach out to us so that we may assist you and help you with your real estate journey, that could be buying your first property, buying your first investment property, selling property, or buying your 10th property. It doesn't matter where you are in the process. Our team, the Kappel Realty Group, is here to help you. You've got my email in the chat, and that's usually the best way to reach out to me. And I usually get back to folks within 24 hours. You can also see in front of you a few other social media sites where you can follow us. One of the best places really is what I'll show you towards the end, and that's our YouTube channel, where you can watch a lot of educational, informative webinars from the past, and the current ones we do are usually uploaded within a day or 2. So let's start out tonight's education with a thesis statement, guys, that I've been saying for nearly a decade. And this thesis statement is starting to play out and become true. And that is that San Diego today is San Francisco 1990. So what do we mean by that thesis statement? Well, let's back up a minute and look at what folks are saying out there and what they're not saying out there. A lot of folks, especially in real estate, are saying they don't have a crystal ball. They don't know what's going to happen in the future. They don't know how we got here. Well, the truth is, You all have crystal balls. We all have a crystal ball that we can look into to see what's likely to happen. And that's called data and analytics. And if you know how to look at, study, and interpret data and analytics, you can make some pretty solid predictions about the future. And let me be clear, it doesn't mean you'll be right all the time, but it does mean you'll be right more than you're wrong. And in life, as long as you're right more than you're wrong, you are winning. So my goal tonight is not to share with you just my opinion or some grifter's opinion off of YouTube, but to share with you real data, real analytics, and interpret that data for you and what it means for the real estate market and the direction it's going. This is something I couldn't have done 10 years ago, but thankfully for the 2 master's degrees in business, finance, and real estate, I know how to look at data these days, and I love sharing it with all of our clients. So back to that thesis, San Diego today is San Francisco circa 1990. What do I mean by that? Well, in the 1990s, you all know that the silicon chip, the technology boom really exploded with it being centered in the Bay Area, San Francisco. All of a sudden, San Francisco real estate values started to skyrocket, not because the homes were built better or because they were plated with gold. San Francisco real estate in the 90s skyrocketed in value because of the economic boom of the silicon chip centered in San Francisco. If you could go on a time machine and go back 30 years to 1992 and buy some real estate, you can see here that the median price of a home back in the early 90s was about 300,000. Fast forward just 30 years and it's 1.6 million. For every one home a person bought in San Francisco 30 years ago, it increased over 5-fold. That phenomena happened because of what happened economically in San Francisco. Again, it's not because the homes were any better or that all of a sudden they were fitted with gold. What's happening in San Diego in the biotech industry is very similar to what happened 30 years in San Francisco in the tech industry. And the thesis of tonight, and you'll see the data and the economic growth to back it up, is that anyone who buys real estate in San Diego today will also likely see their net worth and the value of the real estate they buy over the next 30 years grow 5x. Usually in San Diego, we see the value of real estate over 30 years grow about 3 to 4x just in normal times, and we'll likely see even further growth due to the biotech boom happening in San Diego. So what are we going to cover as we discuss all these items? We'll start out with some of the latest monthly real estate data. One thing we include every month at the beginning of these presentations is what happened in the last month. August isn't done yet, so the monthly data we'll be able to look at today is July. And what did July look like? We'll take a look then what's going on in this economy macroeconomically and how is that affecting our San Diego economy locally here. Most importantly, how is housing being affected? And we look at how housing is being affected. We'll look not just at economics, but also at demographics. What's happening with population movements within the United States, within San Diego. And not only are we going to look at how many people are moving here, but who is moving here and how is that affecting housing. Last but not least, we'll do a look ahead into 2024 and beyond. Economists are already forecasting housing, not just for next year, but all the way out through 2026. So we'll take a look at that. I always like to cite sources. A few of them I have up here: Keeping Current Matters, UCLA Anderson, San Diego Association of Governments, San Diego Association of Realtors, California Association of Realtors. There's many other sources that I do my best to cite throughout tonight's presentation. One source you won't see me citing too much, though, is just headlines. I'll toss up a few headlines and I will tie them to data, but I like the phrase that headlines terrify, data clarifies. And with that in mind, get ready for one of the more intense data presentations you've seen, because what I've noticed and what you have probably noticed is due to social media, there's a lot of misconceptions out there. A lot of times those misconceptions are coming because there's a lot of folks out there who have access to Instagram, Facebook, and YouTube, but they don't have the academic education behind them to really speak intelligently about economics, finance, in housing. They're just trying to get clicks so they can sell advertising. So they're often spilling out bad news, even bad news that probably isn't going to happen. So tonight, we're not going to look at opinions. We'll take a look at real data and how that's affecting real estate. So as I mentioned before, tonight will probably be one of the most data intense presentations you've ever seen. But the purpose of this is because I don't want to just give you an opinion like so many other people on social media do. I want to show you the why. I want to show you the data so you can see why things are the way they are in real estate today and why they will likely go the direction that we project tomorrow. We'll start out with this. We don't have an interest rate problem, guys. Yes, rates are high. They're over 7% right now, but that's something that can be changed with a moment's notice. The Federal Reserve, the US government, can manipulate the economy to change mortgage interest rates. The US government can do things like buying mortgage-backed securities to lower them. The Federal Reserve can lower rates. So that's a problem that's easily fixable and will be. We'll see rates go down likely in the coming years. But what we really have a problem of is housing inventory. That is a problem, capital letters, that the US government can't fix with a snap of the fingers. The US government can't fix that problem by buying mortgage-backed securities or lowering interest rates. The housing inventory problem is the real root of why homes have become so expensive. And that problem is not going away, which will assure home values stay high. Because at the end of the day, the value of everything comes down to supply and demand. And we simply do not have enough supply. When you don't have enough supply, prices go up, period. That is just Econ 101. So with all these things in mind, let's start looking at some data. First of all, the latest monthly data that we've seen in San Diego on sales prices of both median detached homes, and then the next slide we'll look at condos. The real estate market bottomed out, guys, in December and January. Last December and January. Anyone who is waiting for real estate prices to drop like a rock, don't hold your breath. You'll probably pass out because that bottom was December and January. And oh, by the way, back in December and January, we had lower interest rates than we have today. Throughout 2023, interest rates kept going up and up and up. And surprisingly, real estate values kept coming up. And it wasn't because rates, because remember, that's not the real problem. It's because of the lack of inventory we had. From January through July of just this year, we've seen real estate values in San Diego go up 16.6%. Why is that important to know? On the news, you're probably hearing real estate values are up 3%, 4%. You can see in the top right of the screen, it says plus 3.6%. When you see those numbers, you're seeing year over year data, July 2023 compared to July 2022. But prices were going down, as you can see here, throughout last fall, and then started really coming up in January, February, March to today. So what do you need to take away from this? Prices aren't up just 3% or 4%, folks. They're up over 16% in just the last 6 to 7 months. You might notice on the top right of the screen, a little dip down from June to July. In June, the median sales price in San Diego was $1 million. In July, it was pretty close to that, $990,500. You will likely see prices go down this fall, but they're not going to go down because there's a housing crash. They're not going down because people don't want to buy homes. They're going down because since the beginning of human history, real estate values always go down in the fall. Real estate is very seasonal. Real estate values start going up in February, typically every year. Throughout the pandemic year, that was a bit of an oddity, but usually February through June, we see real estate values go up. We typically see real estate values peak around June. And then as we get in July, August, September, kids are going back to school. Families hopefully have already moved in their home that they bought over the summer. And there's just not as much of a real estate market going into the fall. So we see prices soften. That makes the fall and the winter one of the best times to buy real estate. I mentioned, I'm just like you, I'm a consumer. I buy real estate too. And usually when I buy real estate, I try to buy it in the fall and in the winter because that's when we see prices go down a bit. And if you look back on this chart all the way to 2013, you can see that seasonality, that well over the 10-year period, the trend is upward. It's a jagged chart. And that's because every fall prices go down, every spring and summer prices go up. So as we start to see this creep down just a little bit, don't think there's a big crash coming. It's just seasonality. Now you see at the bottom here, I typed in that when rates drop to the fives, home prices will skyrocket. We're sitting around $1 million median sales price in San Diego right now with over 7% interest rates. When interest rates go down into the sixes, when they eventually go down into the fives, and it will eventually happen, when those interest rates go down, you and I both know that buyers are going to flood back into the market, hoping to take advantage of those lower interest rates. But sellers will still not be as inclined to sell because they're sitting on 2, 3, or 4% rates. So we'll still have low supply, but you'll have a lot more demand with the lower interest rates that will come in the future, which is surely going to increase real estate values. You also see on condos that we bottomed out in the December, January timeframe. Now, if you look at the increase we've had on condos over the last half of the year, it's a little bit less, but still substantial with a 9.4% increase in just the last 4 months. And we're sitting around $640,000 for the median condo or attached home in San Diego County. This chart just shows it to you with a little bit more color and splits it up between the single family homes and the attached homes. The single family homes in blue, the attached homes, the condos in red. And you can see as you go back to 2012 on this chart, that seasonality, that even though the lines trend upwards over the long run, every year there's a little dip every year. And that is typically what we see as we go into the months of July, August, September, October, that seasonality dip. As I mentioned here on the right, what's going to happen when interest rates go down? Knowing that we're around $1 million today with 7% rates, we'll see real estate values simply skyrocket. You can also see on this chart just where that bottom was in December and January and how much prices have increased since that time period. Why are prices staying so high, even with high interest rates? It comes down to a lack of inventory. The chart in front of you simply shows how much new inventory comes to market every single year. Now, this is also seasonal. We typically have more inventory coming in the spring and summer months. And usually in the spring and summer months, as you see in the chart, about 3,500 new single family homes would hit the market. This year in 2023, during the peak of the market, we saw less than 2,000 homes per month coming to market, typically in the thousands. That lack of inventory is creating the high prices that we see today, even with high interest rates. For that reason, you see most homes are still selling above list price. Now, let me be clear on something. Just because you pay for more than a property is listed for doesn't mean you overpaid for a house. In fact, as real estate agents, we know that buying a house is not like going to the grocery store and buying a loaf of bread. If you buy a loaf of bread at the grocery store, the price tag might say $5, and when you go to the checkout, it's $5 plus some taxes. Real estate is not something sitting on the shelf. If I compare it to anything, it's almost more like an auction environment where you can get multiple offers and multiple people wanting to buy the same thing. With that in mind, most real estate agents will try to price a home when they put it on the market. They'll price it right below what they think it's worth to get multiple offers in and to bid it up to do best for their seller. So when you buy a property, just because you pay a little over list doesn't mean you got a bad deal. Likewise, just because you buy a property for less than it's listed for doesn't mean you got a great deal. Maybe it was an $800,000 property and the listing agent listed it for $850,000 and you bought it for $820,000. You bought it less than list price, but more than what it's worth. If it really is worth 800, what the percent of list price received shows us isn't that people are paying too much for property. It shows us that there's more demand for property than there is property out there. And we're seeing these bidding wars happen, and we're seeing more buyers than there are sellers. And again, we are in one of the highest interest rates environment in our lifetimes right now, and homes are still selling above list. Days on market is also a nice data point for you to look at and know when looking at real estate. What does days on market mean? Well, from the moment a for sale sign goes in the front yard of a house to the moment it goes into contract, that's days on market. Now, a lot of homes, most homes, go into contract and get an offer accepted within a week or two. Some homes, especially the higher price points, will sit longer. 1, 2, 3 months, especially for the high price points, which brings up that average. But the average in San Diego right now is 24 days, as you can see in the chart in the top right. Anything less than 60 days indicates a hot market where there is not enough supply relative to demand. So if there's not enough supply relative to demand, does that mean you should buy? Well, let me ask you this question. When you buy things, real estate being a thing, would you rather buy something that's going to go up in value, or would you rather buy something that's going to go down in value? I think I know the answer that you would make to that question. You would rather buy things that are going to go up in value. The fact that it's a hot market, the fact that there is not much inventory, there's only 24 days on market, homes are selling for list price, that indicates that real estate values will continue to go up in value. So should you buy real estate in a hot market? Absolutely, because you should buy things that go up in value. Now, if it was a slow market, if there was way more inventory than there was demand, if things were selling way below list price and it was taking 6 months to sell property, you might think, well, it's a good time to buy because it's easy. And the opposite is true. In that kind of market, you don't want to buy because prices are going down. With real estate, you never want to buy a property and then see its value go down and ride the wave down. You want to buy property when the wave is going upwards. Inventory of homes. This chart really paints the picture. You can see going back to 2013 that in San Diego, the blue graph on the bottom, we usually have around 8,000 to 10,000 homes for sale in San Diego. As of last month, we had just over 2,800 homes for sale. So folks, we're operating at about 70% less inventory than what is typical. And that means we have about 25% of the inventory of what we usually have. Imagine going to a car lot that usually has 100 cars for sale, and now it only has 25 cars for sale. What is that going to do to pricing? Is this going to change anytime soon? Likely not. And we'll get into economics and data affecting housing now to show you why inventory is likely going to stay low, why prices over the next couple of years will likely continue to go up, even if we have high interest rates. And it really comes down, as I always say, there's only two things you need to understand when it comes to what direction our price is going to go, and those are supply and demand. Now, the demand side of the equation is human beings. How many humans want to buy homes? And the supply is obvious. It's the amount of homes for sale. So let's look at the demand side, human beings. Most Americans buy a house when they hit their early 30s. 30s is kind of first-time home buying age. In Gen X, my generation, there weren't that many babies, didn't have that many people. But as we get into the millennial generation, those born in the 90s, going into the 2000s even, we see one of the biggest demographics of all time in American history. And right now, that huge demographic of millennials is followed closely by Gen Z, post-millennials. Now, having the largest demographic in American history hitting first-time home buying age, their 30s, is one thing. And that in itself would cause real estate prices over years, if not the next decade or two, to continue to remain strong and keep on appreciating. But there's something else that happened that is going to make home prices escalate more in the next 10 years than America has ever seen. And what is that? The other side of the equation, the supply side. As you can see, we just don't have inventory. In fact, about every decade, America builds around 10 million new housing units. In the last decade, from 2010 to 2020, the United States of America built about half the amount of inventory. We only built about 6 million homes in the last 10 years, and we usually build 10 million. That lack of building homes for this next generation, combined with the fact that most homeowners are now sitting on low interest rates in the 2s, 3s, or 4s, so homeowners don't want to sell, builders didn't make enough homes, we are sitting at all-time historical lows of inventory of homes for sale in the United States of America, with less than 1 million homes for sale at the start of 2023. When you look at these two facts, these two graphs on top of each other, and you see that we now have the largest generation in American history hitting their 30s, first-time home buying age, intersecting with the lowest amount of supply available in American history, what's going to happen to prices? And guys, it doesn't matter if it's houses, if it's cars, or if it's bottles of vodka at a liquor store. If you have less supply than you have demand, you will see prices of that product go up. It is for this reason, and this chart is probably the most powerful chart of the entire presentation tonight. These two charts tell it all and tell us why home prices are going up so quickly. And this is why we say interest rates are not the problem. The big problem is you can't all of a sudden add millions and millions and millions of housing units. You also can't all of a sudden get rid of all these people turning 30. They need to buy homes that just don't exist. For this reason, over the next decade or two, you will see home prices appreciate faster than we have ever seen in any American decade. Behind millennials, you have Gen Z, my daughter's generation. And Gen Z has even more of an appetite to buy homes based on surveys that have been done amongst Gen Z folks. You can see here the total inventory of homes for sale in the United States of America going back to 2017. And again, pre-pandemic, the United States of America usually had around 1 million homes for sale during the summer months. In a healthy market in the United States is about 1.2 million homes for sale. Even before the pandemic, we just didn't have enough housing inventory because we didn't build enough. But things got worse after the pandemic. And you can see ever since the pandemic of 2020, we just don't have the housing inventory for sale. With right now going into August, sitting around 487,000 homes for sale, which is 10% fewer than last year, but 50% fewer than the amount of homes we had pre-COVID. So when you have 50% fewer homes for sale, but the biggest generation, millennials turning 30s, what's going to happen to home prices? They're going to go up irregardless of what happens to interest rates. And this is why, although we are now seeing all-time highs in interest rates, we are also seeing all-time highs in real estate values. And this is also why there is no crash on the horizon. Demographics, lack of supply, and economics all point towards pricing going up year over year, decade over decade. And I've already mentioned that most homeowners don't want to sell because they have ultra low interest rates on their mortgages. Why is that? Because in 2021, due to the pandemic, the US government lowered mortgage rates for the 30-year fixed mortgage. They did it in multiple ways: quantitative easing, lowering the federal funds rate, multiple levers that the government can push and pull to lower rates. So in 2020, 2021, with these low rates, almost everyone that owned a home refinanced it. In the United States of America, 81% of homeowners have a rate below 5%. 61% of homeowners have a rate below 4%, and 23% have a rate below 3%. So if you're a homeowner, put yourself in their shoes. If you're sitting on a mortgage rate of like 2, 3, 4%, why would you sell your house to go buy a new house with a mortgage rate of 7%? 9 out of 10 times you wouldn't. And that's why these homes are not coming to market. But even if they did, guess what home sellers are? They're also home buyers, because when someone sells a home, they don't do it to become homeless. They do it to go buy another home. So that would also add a buyer pool. In California, those low interest rates are even more extreme. As you can see here, 87% have a rate 5% or below, 69% 4% or below, and almost a third of homes in California, 30%, have an interest rate of 3% or lower. Just meaning those homes are not going to come to market. And by the way, those interest rates are locked in on 30-year fixed mortgages. It's very likely that many of these homes will not come to market for the next 10, 20, or even 30 years, because these owners are sitting on such low interest rates. So what's the bottom line up front here? There is not a real estate crash on the horizon. Number two, there's not enough real estate supply. You can't have a crash of anything unless you have too much supply. Number three, over the long term, real estate prices will keep going up. And this is due to what we covered: lack of supply in growing demographics, populations of people hitting their adult years, getting married, having families, and wanting to buy homes. Another fact that you all know very well is rent will keep going up. And we're going to talk about rent in San Diego in a minute, just where it's at. Last but not least, now is a good time to buy real estate. In fact, now compared to maybe a year from now, 2 years from now, 3 years from now, now is an excellent time to buy real estate. And let's get into why. So this chart in front of you shows you interest rates on the 30-year fixed rate mortgage and how they correlate to how buyer demand increases and decreases. You can see that buyer demand gets a little bit weak when we're above 6.5%, certainly above 7%. Buyer demand starts to grow as we fall below 6.5% and then below 6% interest rates. So, just based on the first 30 minutes, we don't have enough supply. That there's a lot of people that want to buy homes, but maybe they're not for one reason or another because of high interest rates. So is it wiser to buy real estate now when rates are 7% and you don't have as much competition? Or should you wait for rates to fall? And when rates fall, everybody that's wanted to buy a house is going to come in the market, and that is going to push prices up even higher. So what do? Well, you really got to think, what way are interest rates going to go from here? Because there's one thing that you can do. A lot of people who haven't bought a home before might not be familiar with this concept, but you can buy a house with today's interest rate of 7%. And when interest rates go down, you can refinance your interest rate into a lower interest rate. I've got a house that I refinanced 4 times. So if you buy a house today at 7% and interest rates go down to 6.5%, refinance, you lower your mortgage payment. They go down to 5.5%, refinance again. You and I both know that as interest rates go down, home prices will go up. You'll be glad that you bought at 2023 home prices before they go up further in 2024, 2025, and you can always refi into that lower interest rate. So it begs the question, what direction are interest rates going? Well, we saw that the Federal Reserve has raised the Fed funds rate to a 22-year all-time high as they continue to fight inflation, which has come down a lot. And that Federal Reserve interest rate hike bleeds over to the 30-year mortgage. So let's get a little deeper into that. A quick 5-minute education on why are interest rates the way they are. What you're about to learn in the next 5 minutes, I guarantee you most home buyers don't know, and I guarantee you most real estate agents don't know this. So pay attention, because this is really going to help you understand why you should do what I'm saying. Buy now and refi later. Mortgage rates, you see, typically have about a 1 to 1.5% spread above the rate of the 10-year Treasury. What do I mean by that? Well, the 10-year Treasury note is a government bond. It's a government bond, and the interest rate of it is set by the government. And usually, the 30-year mortgage is about 1 to 1.5% higher than the 10-year government bond Treasury. The 10-year bond right now is around 4%. So what's 1 to 1.5% plus 4%? About 5 to 5.5%. So what am I saying? Mortgage rates right now should be about 5 to 5.5, but they're not. Why aren't they? Well, let's take a little deeper look. As you can see in this chart, you are looking at the blue line, which is the 10-year Treasury, the government bond, and the red line, which is the 30-year mortgage that we use to buy our homes. And you can see going back decades, there's usually a gap of about 1.5%. Why is that? Because guess who buys all these things? Wall Street. And Wall Street investors, billions of dollars, they want to get about 1 to 1.5% more return on their investment when they buy your 30-year mortgage versus the government's 10-year Treasury bond. But why have they increased to a 3% spread in the last year? Why are they not 1, 1.5? In fact, we can see how much that spread increased from November 2021 to November 2022. We went from the typical 1.5% spread, and all of a sudden mortgage rates just zipped up faster than the 10-year Treasury to a 3% spread above the 10-year Treasury. Well, the reason for that is because investors, and when I say investors, I don't mean real estate investors. I mean investors on Wall Street. Investors on Wall Street are buying these 30-year mortgages. Investors on Wall Street are buying these 10-year bonds. And investors on Wall Street know that we are at the peak of these interest rates. They probably won't go too much higher. Wall Street investors also know that the 10-year bond, the government can't refinance that. If the US government sells Wall Street investors a 10-year bond that guarantees a 4% payment for 10 years, they can't refinance that. The government has to keep paying that 4% for 10 years. But if you, the American consumer, buys a house with a 30-year mortgage, you can refinance that mortgage 6 months later, 1 year later, 2 years later. You can refinance that mortgage as many times as you want. So on Wall Street, if you think that we're at the top of the interest rate environment and rates are going to go down, that means all these Wall Street investors are thinking any 30-year mortgage that is generated today and sold on Wall Street will probably only exist for about 1, 2, 3 years at the most. And then that mortgage is going to get refinanced, and the Wall Street investor just lost their investment because you got rid of that old mortgage, you got a new one with a lower interest rate. So all of these big time investors on Wall Street are saying, since you American consumers buying homes today are probably not going to keep your 7% mortgage forever, you're probably going to refinance it into 6%, maybe even 5% in the next few years. We need to get a bigger spread. We, Wall Street, they're saying need to get a bigger return than 1.5% above the 10-year Treasury. And Wall Street is saying they need a 3% return above the 10-year Treasury. So with the 10-year Treasury sitting around 4% plus or minus, Wall Street is saying they need returns of 7%, 3% more than the 10-year treasury, because they're concerned you're going to refinance this mortgage within a few years, because you will. So what does all this tell us, understanding finance and economics? It tells us that the government and the big money, Wall Street, are all predicting mortgage rates to fall over the next few years. Are they going to fall tomorrow or next month? Who knows? Probably not. It's easier to predict long-term than short-term. And we can see by looking at what's happening on Wall Street with rates that all the big economists, the government, and Wall Street are predicting mortgage rates to fall. So now that we know that the odds are mortgage interest rates will fall over the next 1, 2, or 3 years. And again, they might go up a little bit more this year, but not a lot. But over the next few years, that's what you really got to look at least a 2, 3 year timeline. Mortgage rates will likely fall. And how is that going to impact affordability? Well, let's look at a person that can afford a $4,000 mortgage. When someone can afford a $4,000 mortgage in a 7% interest rate environment, that means they can afford about a $750,000 home. If interest rates fall, you can see how that payment starts to go down. Well, someone who can afford a $4,000 mortgage, as interest rates start to go down, as you can see here at 4.5%, now that person, that same person, can buy $1 million property. So that is why, as we see interest rates go down, we see the purchasing power of individuals go up, and we see home values go up. This is why, as you'll see in a few future slides, most economists are predicting home prices to go up quite a bit over the coming years, because they're expecting interest rates to go down. So as a savvy consumer, what should you do knowing this information? You should buy today when the price is low. Buy that $750,000 home at a 7% rate with a $4,000 payment. And when rates go down, you can refi into a 6, into a 5, into a 4.5, and you can see how your monthly payment will subsequently go down. But if you wait, or if any of your friends wait for rates to go down, you'll be part of the herd of people rushing into the market all at once and driving up home prices. So what should you do? Wait to buy, or buy and then wait? What we're telling our clients is buy now while real estate prices are relatively low compared to what they could be in the future. Now, you might be thinking, Patrick, prices aren't low. I get it. $1 million is not low. But if you really want to understand finance, real estate, economics, and you should understand it to some degree if you're making a big purchase like this, you need to not only be able to see where prices have been in the past, you need to be able to see where prices are going in the future. Because prices of just about everything, cars, food, gas, clothing, houses, vacations, prices of everything is almost always lower in the past. And they seem higher now because they are higher now in the past. What you got to be able to look at is, where is the value of this thing going to go in the future? And almost everything goes down in value as time goes on after you buy it. Like cars go down in value, clothes go down in value after you buy it, even though the shelf price keeps going up. Real estate is one of the few things that keeps going up in value after you buy it. So a lot of our clients are like, yeah, I'd love to buy now, but I don't have the down payment. That's why you should check out the YouTube channel, because we have many other webinars that discuss free money that you can access to buy real estate in California. There's programs out there that'll give you tens of thousands of dollars. We even had a client earlier this year get the state of California gave him over $130,000 to buy his first house, tax-free money. So if the only thing holding you back is that down payment, check out our YouTube channel or shoot me an email and we can get you connected with some of these down payment programs. The other question we get often is, but isn't it cheaper to rent than it is to own? Well, let's take a look at that because this comes up a lot. Isn't renting cheaper than owning? And I used to be a renter, guys. I get it. I went through same life process we all go through. So let's compare renting versus owning. You're looking at a bit of an eye chart and you're like, whoa, what is this? What is this you just put in front of me, Patrick? This is an Excel spreadsheet that I built when I was in graduate school, getting a master's degree in real estate. And I wanted to show mathematically why renting over the long term is way more expensive than it is to own. So let's dive into this and show you how owning real estate, even though your monthly payment might be a little higher now, is much cheaper than renting. We're going to use a sample property here, 801 West Hawthorne Street. I know this property very well because I own it. I bought it in 2009. It's worth around $500,000 today. So if I sold it, I'd probably sell it for $500,000. Now, let's say you could buy this property or you could rent it. And what if I told you you could buy it and your mortgage would be almost $4,000 a month? Or you could rent it and your rent would be $3,000. And I know the rent is $3,000 because I rent this property out. What would you do? Would you own it for $4,000 a month or would you rent it for $3,000? Most people would say they would rather rent it for $3,000 instead of owning it for $4,000 because $4,000 is $1,000 more than $3,000. And I get it. That makes some sense. But I want to show you how owning it for $4,000 a month will make you $3 million wealthier than renting it for $3,000 a month. And how the $3,000 a month in rent ultimately will become $12,000 a month. So how does this work? Let's look at the math. Let's say you buy it for $500,000. You've got some closing costs, you do a down payment, and you can buy property with as little as 5% down. So in this case, this would be $25,000 down. And if you use one of the government programs, you get the government to pay that $25,000 for you. Let's say your interest rate is 6.5%. And we're able to get clients' interest rates around 6.5% these days, still now and then. And the term is a 30-year mortgage. As we go down to the bottom left, a few more assumptions. Let's say the property appreciates at 6% year over year. That's a pretty good number to go off of because over the last 35 years in San Diego, the average rate of appreciation has been 6% year over year. I already said you can rent it for $3,000, so we got that number here. And let's say your rent goes up only 5% a year. I say only 5% because in San Diego, on average, rent typically goes up much more than 5% a year. We also see in the top right that when you own it, you have some additional costs beyond just your mortgage. You got to pay real estate taxes, usually 1.25% of purchase price. You got to pay insurance on a property like this, around $800. You got to pay HOA, again, on a property like this, around $400 a month. So now that we have all these inputs, let's take a look at the outputs. The first one I already told you, and you see it on the far right. If you buy this property, you're going to pay almost $4,000 a month in your mortgage, plus HOA, plus your insurance. So about $3,990. If you rent it, you're only going to pay $3,000 a month. Now, most people would stop here and they would say, well, Patrick, I'm going to rent it because $3,000 is cheaper than $3,990. And I wouldn't disagree with you. But if you're going to live more than the next few years, and I hope all of you live for decades and decades and decades, live another 100 years. I'm going to assume that you also plan on living for as long as possible. Then you need to plan, not for today, but for the long term, for your life, right? Maybe your parents told you that at some point. So let's look at what happens to the renter and the owner in the coming years. In fact, over the next 10, 20, 30 years of their life. Over the next 30 years, the owner will pay $1.597 million, almost $1.6 million. The renter will pay $2.391, almost $2.4 million. The renter pays almost $800,000 more over 30 years. How is that? Why is the renter paying so much more money, almost $1 million more over 30 years, if the rent was cheaper than the mortgage? One very simple reason. Mortgages stay the same for 30 years. Your principal and interest payment doesn't change. It stays the same for 30 years. Rent goes up over time. We all know that. So how much is it going to go up? Well, by the time we get to year 31, 30 years have passed. Your mortgage is now paid off if you're the owner. All you have left to pay is your annual taxes, insurance, and HOA fees, which even with the rate of inflation will be about $2,000 a month. Not bad. If you're the renter, $3,000 a month, going up just 5% a year becomes over $12,000 a month in 30 years. And that seems insane. How does $3,000 go up to $12,000 a month in rent? Guys, that's the power of compound interest. And when a rental rate is going up 5% year over year, it becomes $12,000 by year 31. This that you see circled in red is the number one reason why homeowners can retire and renters typically have a hard time retiring. Because 30 years from now, most of you are probably going to be thinking about retirement. How are you going to retire when your rent is 4 times what it was worth? I'm in my mid 40s and I've got friends who are thinking about retiring in the next 10 to 20 years. And many of them who have been renting their whole lives are sweating bullets because they don't know how they're going to retire because they haven't built up equity in a house. They don't have a fixed living expense of a mortgage, and they have ever increasing rent. Now, I also mentioned not only is it going to be easier to retire because your payment is much lower, but you've built up a nest egg because the renter has built no equity. They've only built equity for their landlord. The owner, on the other hand, had a 30-year fixed mortgage. The mortgage is paid off after 30 years. And how much do you guys think a $500,000 condo is worth after 30 years, appreciating at 6% a year? A little over $3 million. This is how any of you can become a multimillionaire. Everyone I speak to, I always say there is no reason you should not become a multimillionaire. Forget about becoming a millionaire, multimillionaire. If you're able to get $25,000 scraped together, or even better yet, have the government pay for it, and you qualify for a mortgage, you can be a multimillionaire within 30 years by just owning real estate. So hopefully these numbers really put it into perspective why owning is cheaper than renting, massively cheaper over your lifetime, even considering today it might look more expensive, but today is a drop in the bucket of your life, and you will pay a lot more by renting. Moving on from that, there's an article that recently came out in the San Diego Union Tribune, and really is a national article, saying that most Americans now are predicting they need to save $1.8 million in net worth in order to be able to retire. And I'm telling you, most Americans will not save 1.8 million. Most Americans, especially in our generations, are going to have a hard time retiring. The few Americans that will be able to retire are those who own real estate. So owning real estate not only gives you a house that you own and you live in and the pride of ownership, it also sets you up for long-term financial security and financial stability so that you can retire one day. Well, you can always put your money into other investments as well. So I put together this little graph that shows you what happens to $50,000 that you invest in real estate versus $50,000 that you invest in like a 401k. Because trust me, sometimes you got to make hard decisions. And sometimes the hard decision is, should you buy real estate, a house to live in, or should you keep on renting and max out your 401k, TSP, whatever it is, your IRA? Well, even if your retirement account, your 401k, hits a really high return at 12% year over year, which you see here circled with my cursor, your return of $50,000 growing at 12% over the next 30 years will give you about 1.5 million, 1.497 to be exact. And you see that in the red line on the graph. If you took the same $50,000 and you said, you know what, for a couple of years, I can't put money in my 401k because I'm going to make the adult decision to buy a house instead of renting the rest of my life. And you say, okay, no more 401k for a few years. And I did this myself, guys. And I took that money and you put it as a down payment on a house. That same 50,000 down payment on a house, and in this case, 5% down, $1 million home, average home in San Diego. Grow that home now appreciating at 6%. Half of what your 401k might grow at 12%. The home is only growing at 6%. But after 30 years, you have a $5.7 million asset. Not 3 million, 5.7 million. And you can see that in the green line here. Your net worth is going to be about 3x, if not more, higher by putting that money into real estate versus your 401k. So now we're seeing that the smartest place to put your dollars is not in your retirement account. And I am not knocking retirement accounts, guys. These days, I do put money in my retirement accounts. But when I was in my 20s and 30s and I was buying my first real estate properties, I knew this math. And I knew that real estate could do more for me in the long term than what 401k could. So putting that money into your house is going to help lead you again to that retirement, financial security, financial freedom. With those numbers, I know we went a little deep on numbers. Let's start looking a little bit more at macroeconomics, because the last half hour, I want to kind of talk about the direction things are going and the direction they will likely continue to go over the next 12 months. So inflation, as we see in the chart, boy, this is a bit of an eye chart too, but don't worry, you can take a snapshot or watch this on YouTube. But we all know inflation is going down. In fact, Consumer Price Index, what we typically look at for all items in inflation, peaked out at 8.9% about a year ago, June of 2022, and it has since fallen to 3.3%. So in about a year, guys, we went from roughly 9% year over year inflation to 3%. And we're continuing to trend down and hang out in those threes. The Federal Reserve wants our inflation around 2%. So they'll keep doing what they got to do to get us to 2%, maybe one more little rate hike. But one thing to keep in mind with inflation is it happens all the time, even in normal economic environments. As I mentioned, the government wants inflation around 2% every year. And they usually come pretty close to that target. You can see in the 90s, the 2000s, the 2010s, and 2020s, we were sitting between 1.5% to 3%, kind of in that 2% window plus or minus they want. Then we started seeing massive inflation in 2021. We also saw it back in the 70s and 80s. One thing to key in here, though, is as much as inflation is always around, real estate is one of the best hedges against inflation. Because as you see in the chart in front of you, the green bar graph in almost every single decade higher than the blue bar graph, indicating that real estate values appreciated more than what year over year inflation was every year, creating one of the best hedges against inflation for you. Now, if you don't buy real estate and you remain a renter, you're getting a double whammy. I like to call it punched in the face twice, because first you're taking a hit by not enjoying the advantages of owning real estate and having a hedge against inflation. And second, you're taking a hit on the rental side, because as you can see, the green line again above the blue line, rents also usually go up faster than inflation in the United States. Now, what you're looking at right now is a headline from about a year ago, October 2022. And it was October 2022 when economists were saying there's almost a nearly 100% chance we will see a recession in the next 12 months. That said, economists have changed their mind a little bit. And now they're saying the odds of a recession are about 50-50. We might see a recession, we might not. I'm here to tell you no matter what direction it goes, it's good news for real estate. Why is that? Because if we don't have a recession, people keep their jobs and folks can keep buying real estate values go up. If we do have a recession, guess what? Real estate values usually go up. You see, a recession doesn't equal a housing crisis. If we look back at the last 6 recessions, during 4 of the last 6 recessions, home prices went up. Why do home prices go up during recessions? Because of this. Recessions mean falling interest rates. Usually, when we hit a recessionary environment, interest rates go down to help get us out of the recession, and falling interest rates usually means home values going up. As much as I just showed you a headline, I want to also show you that you can't always believe the hype and believe the headlines, because here's a headline that popped up not too long ago stating that U.S. foreclosure activity doubled annually in 2022 compared to 2023. If you just saw the headline, foreclosures doubled, you would think, wow, we're leading towards a crash. And I saw some YouTube folks, I saw some Instagram folks say this line to try and just get clickbait that foreclosures are doubling, but not annotating that they're still historically low. In fact, when you zoom in on San Diego County, you can see foreclosure activity going back to 2012, still at all-time historical lows. There's just no stress, guys, in the housing market. You are not going to see a collapse. When you look specifically at just Southern California as a whole, you also see, as of 2023, foreclosure activity is all-time low. There's no stress in the housing market. Now, what are the forecasts going out for the next couple of years? Well, at the beginning of this year, the 2023 forecast was appreciation by most folks except Zelman. I don't know who Zelman is, but they certainly got it wrong. It's probably why I don't know who they are, because I don't listen to people that are usually wrong. If you look at the others, though, the Fannie Mae, Freddie Mac, MBA, HPS, and NAR, they were all predicting appreciation, but they actually got it a little bit low, because as you see on the right, San Diego year to date is already up 16%. As we look out, though, beyond 2023 and into 2024, how are things looking? Well, this article just came out from a recent Zillow study, and they highlighted in blue the areas where Zillow economists are predicting appreciation over the next 12 months, July to July of 2024. And we can see down here, San Diego County, a relatively dark blue. And by the way, the darker the blue, the more the appreciation. No surprise, Florida, some parts of Texas, the Southeast, and certainly all of Southern California in the Southwest appreciating, because as much as you might see headlines that tell you that people are leaving California, the opposite is true for Southern California. Southern California's population is growing, and we'll show you on some census survey charts in a moment. But what about beyond 2024? As we get into 2025 and 2026, more and more economic analysts are forecasting appreciation. You can see in 2024, 86% of economists are predicting appreciation. In 2025, 91%, and in 2026, 96.8, almost 97%. So as we go on through the years, because of the demographics I shared with you at the beginning of millennials getting into the first-time home buying age and a lack of supply, as we move throughout the years of the next decade, economists are predicting more and more so appreciation of real estate. I always, when I was a little kid, I used to ask my parents why I have to do something, or ask adults why. And they would always say, because I told you so. And I never liked that answer. Never like it when someone just says, do it because I say it, or believe me because I say it. And that's why I always like to show you the why before I show you the what. And the why is lack of inventory, big demographic hitting first-time home buying age. The what is appreciation, appreciation, appreciation. It's going to happen. Home values will keep on going up. So let's zoom in a little bit. during the last little portion here on California and the San Diego economy. Again, it comes down to the most powerful force, supply and demand. So what does supply and demand look like in San Diego? Well, in San Diego, over the last decade, from 2011 to 2021, we needed to build 146,000 new housing units just to meet our growing population demand. And we built less than 70,000. We built less than 50% of the homes that were needed. This shortage of almost 100,000 homes has created an enormous housing gap in California. And that's why we have such a housing crisis here in San Diego County. That housing crisis is ensuring that real estate values will stay high and continue to go up. At the end of the day, I always like to say the value of real estate is also heavily dependent on the value of the economy around the real estate. That's why real estate in San Diego, one of the best cities in the world to live in, not just for our good weather, but also for the diverse economy that we have here. That's why real estate values are higher here than many states in the Midwest, because we have better weather, we have a better economy, we have a faster growing economy, and overall, it's just a more desirable area. Real estate values are very closely tied to the economy. And when you look at California's economy, you see that we are now the fourth largest economy in the world, and that's compared to nations, not compared to other states. Compared to nations, we just overtook Germany. What I like to highlight, though, when you do compare us to other states, and oh, by the way, the next few charts are why I do not invest in real estate out of state. When I buy real estate with my wife, we buy real estate in Southern California. I'll show you why. Southern California has the largest economy in the entire continental United States. In fact, when you look at the gross domestic product of each state, Southern California, and California as a whole, most of the economy is Southern, but we got some stuff up in North, but California's economy is 3.36 trillion, almost 2 times the size of the economy of second place, Texas, which has a much smaller economy compared to California. Additionally, when you look at the GDP per capita, so what is this? This is money per person in each of the state. We see that California, again, ranks in the top 5 with a GDP of $85,000 per person. There's just more money in California per person compared to some of these other states. That's why real estate, look at the light colored states. You get some Arkansas, some Louisianas, these light colored states, West Virginia, they have low value real estate that will probably never go up that much in value because GDP per capita is just not that high. Anyone during the pandemic who bought in Idaho, good luck. Not a good decision. That's a knee-jerk reaction. You should not buy real estate, in my opinion, in these states with light colors unless you live in these states and you need a place to live in. But I would not invest in those states. You want to focus on the darker colored states that have a higher GDP per capita to ensure your real estate value, 1, will hold, 2, will go up, and 3, if you're an investor, your rents will be paid. Next, this shows you GDP growth. So what states are growing the most economically? And when you look at this, the economics can tell you which states are likely to have the most appreciation of their housing stock. And we can see here that California, as well as Nevada and Tennessee, and what is this, New Hampshire up here, are seeing some of the most GDP growth in the entire United States. This last chart simply shows you what percentage of the total US economy does every state make up. And there it is, California again at number 1, 14.8% of our entire nation's economy is Southern California. And it has grown more than just about every other state. I like to go back to this one because anyone who says California doesn't know how to run itself politically to keep businesses in California is wrong. All you got to do is look at the numbers, not the headline. I like to say words can lie, but not numbers. Numbers are where you find the truth. And we see businesses are actually growing quite well in California. A lot of that is coming from Southern California, as I mentioned, specifically San Diego. In the San Diego economy, we see that we have a younger, richer, and better educated demographic, as you see on the left. And we have a forward-looking economy focused on the 21st century, really heavily weighted in biotech. And we are growing our population in San Diego. What you see in front of you is the diversity of our economy, with tourism, innovation, biotech, and military really being the driving sectors that you see on top. But another key takeaway is no segment of our entire economy takes up more than 16% of the San Diego region's economy, which means for us, we're recession resilient. Where else would I not buy real estate? I wouldn't buy real estate in a city, a state, or a county in which a large portion, and by that I mean 25, 30, 40% of the economy is based on one thing, like farming or oil. If you're heavily weighted in one industry, any tweak in that industry can cause real estate values to plummet. But we're not going to see that in San Diego, because not only do we have a diverse economy, but San Diego's economy is harnessing the power of the sixth wave of innovation. And that wave is life sciences, which is changing humans forever, changing economies forever, and it's going to change cities forever, the way the silicon chip changed San Francisco forever. Yes, back to our thesis statement, the silicon chip that changed San Francisco forever and San Francisco home values is going to have the same effect in San Diego, but instead of the silicon chip, it's the life sciences. It's biotech. And we see all that money flowing into San Diego through innovative venture capital money. In fact, our region typically receives about $1 billion a year in venture capital money, going back over 10 years. But when you look at the last few years, going into 2021, venture capital money pouring into the San Diego region has grown exponentially. In fact, in 2021, we saw over $9 billion of venture capital money coming into our region, 8.6 higher than the long-term average. When you look at what is that money funding by industry, you see on the left that over 5 billion of it is going to life sciences and 4 billion going to just general tech. You can't take a sleepy little town like San Diego that usually gets about $1 billion in outside investment and all of a sudden start putting in 5 billion, 8 billion, 9 billion, and not have a forever change on not just our economy, but also our home values. And you can see over here how it's broken down by life sciences on the right, from early stage to growth. There's a lot of growth occurring in San Diego the same way it happened in San Francisco in the 1990s. Your teachers and your parents always taught you that history is the best teacher. If history is the best teacher, let's take a lesson and look at the history of what happened to San Francisco in the last 30 years, when all that innovation capital was dumped into the Bay Area, and how home prices grew 5x in just 30 years. And I am now seeing that same history repeat in San Diego, but we are at the very beginning of it, meaning you and I are lucky. We are lucky enough to be at the beginning stages in a city where, yes, you can buy a home for $1 million, $500,000 for a condo. It's not small money, but imagine how that's going to grow over the next 10, 20, or 30 years. When we look at the money, the venture capital going into all the major metropolitans throughout the United States, we see that there is no city in the United States gaining more venture capital money than San Diego. We are gaining more VC money than Seattle, than Denver, than all of the major growth cities. Now, this doesn't take into account San Francisco. This takes into account only the growth cities, the cities that are not already big developed biotech and technology empires, the cities that are developing into biotech empires. None of them are receiving more money than good old San Diego. And we see that in the forms of real estate purchases. Over $3.4 billion last year was invested in San Diego biotech real estate purchases, where they're building lab spaces and office spaces. Again, we're painting the picture of how you can become financially secure by owning real estate, and most likely very wealthy beyond what you ever imagined. because San Diego today is San Francisco circa 1990. And we're seeing it through more development from downtown to Mission Valley to South Bay to North County, things like the IQHQ San Diego Research and Development District, the most expensive waterfront biotech development happening on the west coast of the United States right now. $1.6 billion right downtown by the USS Midway. Across the street, we also see the Seaport redevelopment that is going to come at a price tag of $3.5 billion. So you have over $5 billion of new economic and venture capital and tech money going into a small radius downtown. We also are witnessing a $1 billion project that SDSU is building called the Innovation District in Mission Valley. Mission Valley has a lot more than just what SDSU is building. There's a $4 billion project that is not tied to SDSU, which will ultimately add over 4,000 new apartments, 150,000 square feet of retail, and over 1 million square feet of new office space throughout the revitalization of Mission Valley. As you move a little bit up north, we see that Apple recently announced that San Diego is going to become a principal engineering hub for the Apple company. They're going to have over 5,000 new high-tech jobs in the San Diego region. And with that announcement, they bought a nearly $500 million brand new Apple campus in San Diego County, what used to be the old HP campus. We also see with the healthcare and the biotech fusing together, a new $2.5 billion UCSD hospital complex in the Hillcrest neighborhood. And just a few blocks away from the UCSD Hillcrest Hospital, Scripps has unveiled a brand new $1 billion hospital that's going to be replacing and adding on to Scripps Mercy. As we go further down south, one of my favorite areas to invest in, the west side of Chula Vista, where we see now a $2.8 billion renovation and revitalization happening along the waterfront. If you drive down the Interstate 5, take a look towards the waterfront in Chula Vista, and you're going to see one of the tallest buildings on the skyline coming up. And what you're looking at is one of the largest hotels in Southern California and the second largest convention center in San Diego being built out. There's going to be a resort-like area, not just with convention and hotel, but also some residential and office parks and hotel areas. Go a little bit east and you'll find the largest Amazon facility in the entire state of California. One of the largest Amazon buildings in the world is right here in San Diego County. Guys, if you don't think San Diego today is San Francisco circa 1990, and you saw how real estate values grew 5x in 30 years in San Francisco, look at what is happening in San Diego. And we used to be a sleepy little town for forever. We've always been a sleepy little military town. And in just the last few years, we are really at the beginning of an explosion of tech and venture capital in our region. With that explosion of business development, we have many more people coming in and out of San Diego, not just for tourism, but also for business, requiring our airport to be expanded and redeveloped. This is one of the biggest projects in our region, a $2.7 billion addition to the busiest runway in the United States of America, San Diego's airport. And of course, you can't talk about San Diego without the military. The military economy is growing at a rapid pace because of the Pacific Pivot. Our foes in the mid-1900s, Germany, the Nazis, the European wars, our foes and our economic competitors are now shifting towards countries in the Asia Pacific region. And for that, we are building up the Pacific Fleet and a lot of our East Coast military forces moving to the West Coast, growing the Department of Defense spending in our region. And another fact is that every year over 15,000 military vets get off active duty in San Diego, and over half of them remain in our region. Another little known fact is San Diego is the #2 recipient of Department of Defense dollars. Many of you might have heard that one of the biggest expenditures of the United States federal government is the Department of Defense. Something like half of the federal spending goes to the Department of Defense. And a large chunk of that money comes right here into San Diego, the #2 recipient of DoD dollars. As you zoom in, more so on the civilian side, shifting it back, and you look at the growth since the pandemic in the last couple of years, no city's downtown has recovered as much or as quickly as San Diego. And this is all major cities throughout the United States. In fact, in San Diego, our downtown now has more businesses and more revenue being generated than we did before the pandemic. As you look on the chart in front of you, you see many cities haven't even recovered halfway yet. But San Diego's growth is second to none, as you can truly see in the graph before you. San Diego is the destination folks want to move to. In fact, even with our high home prices compared to the Midwest, San Diego has become the #3 destination that home buyers are moving to. When I say home buyers, I mean those who are moving more than 50 miles away. You can see it here on the chart that in fact, California cities make 2 of the top 3. These are the top 10 metros of net inflow of users in their top origins. So when anyone tells you folks are leaving California, don't believe them. San Diego is growing more in their net inflow of folks than just about every other city in America. And a lot of these people are coming from finance and tech cities like Seattle and Los Angeles. And who is moving to San Diego? I always like to say it doesn't matter just how many, but also who. And we can see by a LinkedIn study that the folks moving to San Diego are working in the tech industry. It's all tech people moving here. In fact, when you look at all cities in the United States, San Diego's tech talent growth has outpaced every other city. And from 2019 to 2022, San Diego's tech talent grew by over 38%. No website can track this better than LinkedIn, because LinkedIn knows your education, knows your industry, and knows where you live. So LinkedIn is able to give us this data on where is talent growing the most, no more than San Diego. As you can see here, population change. This chart is pretty basic. The darker the green, the more people are moving there. It doesn't get any darker than San Diego County. You see how dark green that is? Also a few spots in Texas, a few spots in Florida, but Southern California's population is growing tremendously. It's really Northern California where you see some of the yellow counties. That's where people moved away from. In fact, based on the last census, which recently happened, in the last 10 years, San Diego County grew by over 229,000 people. Riverside County, right next to us, grew by another 287,000, leading to over 500,000 folks moving into just San Diego and Riverside alone in the last 5 years. So San Diego cheap? I would argue if you want to know if something's expensive or cheap, don't look at what the price was yesterday. Look at what the price will be tomorrow. And because yesterday is done, but you're going to live for tomorrow. And is the price of San Diego real estate today cheap compared to what it will be tomorrow, next year, 10 years from now? And the answer is absolutely. In fact, in my opinion, looking at all the data we've gone through, San Diego is some of the most undervalued real estate in the world right now, because San Diego has more potential for economic growth and explosion than just about every other region in the world, not just the United States. And we're seeing that growth come to roost. San Francisco historically has always been the California city that appreciated the most. But as you see in the chart in front of you, starting around 2021, San Diego, the purple line, began to overtake San Francisco, the gold line. What does that mean? That means for the first time ever, San Diego real estate is now appreciating faster than San Francisco real estate because we have a lot more growth occurring. This is why I draw the analogy back to San Francisco 1990s. And I love to share with you the chart of what happened to San Francisco real estate values over a 20 or 30-year period because of the tech boom, and relate that to what's happening today in San Diego to emphasize the biotech boom of today will do to San Diego real estate values what the tech boom did in years past to San Francisco. And those who bought San Francisco real estate in the 90s became millionaires. Those who bought multiple properties become multimillionaires. Those who buy San Diego real estate today, likewise, will also become wealthier than they ever imagined, but more importantly, financially secure in a city that will always become more expensive as time goes on. I've talked about the lack of building, and this zooms in just on San Diego. You see, in San Diego, we need to produce over 21,000 housing units a year just to meet our growing housing demand. Yet our average housing production since 2015 has been just about 9,000. We're building less than 50% of the homes we need to house all the people moving into San Diego. And that trend will continue, trust me, because we just don't have the land to build on unless we do infill, which becomes very expensive and time consuming. We also see the intersection of folks moving into San Diego with the biotech boom, 2018, 2019, all these folks moving in, the household formation. These are highly educated, highly compensated, wealthy millennials working in tech. Many folks I meet making $100,000, $200,000, $300,000 a year, and they're in their 20s and 30s, but they work in tech. That's who's moving to San Diego. And right when all these people started moving to San Diego, we stopped building homes almost completely. You can see in the blue line how it just dropped off the face of the earth. Beyond these millennials is Gen Z. And even more Gen Zers, based on surveys, want to buy a house. Gen Zers, guys, are those people in college right now. And almost 50% of Gen Zers want to buy a house in the next 5 years. When you go out over the next 10 years, a full 75% nearly want to buy a house in the next 10 years. And we just have not built enough. So as the chief economist of NAR says, there is not a real estate bubble, folks. It is simply a lack of supply. Even a little bit of a celebrity, Barbara Corcoran, you've seen her on Shark Tank. But what you might not know, if you watch Shark Tank, you might know it, Barbara got her start in real estate. She started simple means and became wealthy beyond her imagination through real estate. She knows a thing or two about real estate. And she announced just a couple of months ago that today, now, is a good time to buy because the minute interest rates go down, everybody waiting for them to go down, and even by a point, 6%. When they do, everyone's going to come rushing back into the market. And as Barbara says, prices are going to explode, and you're going to be paying more for the same house. You can always refinance, she says, as I mentioned early on in tonight's presentation, and when interest rates come down. Barbara is a self-made multimillionaire on Shark Tank now, knows a lot about real estate. Her advice is just as good as my advice, if not better. And I love to see people like this really aligning with the data. We also know, as we discussed, renters have never managed to generate wealth. It's just too hard when you're always paying more and more to live somewhere, year over year, decade over decade, versus the homeowner who has an asset truly appreciating for them. Because as we know with rent, it just keeps on going up. You can see, and this is national, not San Diego, not California. Median rent today nationally is around $1,400 a month. And if you go back just about 30, 35 years, it was only $350. Look at how much rent goes up in just 30 years, folks. That's about a 5x, a 4 to 5x growth. When we look at San Diego, we're seeing rent go up even faster because of our population growth, demographic growth, the biotech explosion. And when we look at San Diego over the past 3 years, we're one of the top 10 cities on rent growth, rent appreciation, one of the only California cities along with Riverside. And this article just came out last month in July. For the first time ever, as I mentioned, San Diego is already surpassing San Francisco on appreciation. We haven't surpassed them yet on home prices, but we just surpassed San Francisco on rent. It is now more expensive to rent in San Diego than it is to rent in San Francisco. And it was unheard of just a few years ago for San Diego to be a more expensive rental market than San Francisco. But now that we have seen in just the last year or two, San Diego rents more expensive than San Francisco, imagine what's going to happen in the next 5 years. You're going to see rents in San Diego skyrocket. You're going to see home prices in San Diego skyrocket because of the data we're looking at. So you're probably thinking there, man, this is great data, good stuff, believable. It's raw data and it's explained. And your biggest concern is probably the biggest concern of Gen Zers. How do you buy a home? Knowing that it financially makes sense over the long run to own a house instead of rent, even if interest rates are 7%, even if owning today is more expensive than renting today, over the long run, you know it's cheaper. How do you do it? And these are the hurdles that usually stop people. Not having enough savings for a down payment, not knowing where to begin, finding a home in your price range, not having good credit, not having too much student loan debt. These are all challenges, yes, but they're challenges, guys, that are easy to overcome when you work with a professional that teaches you how to overcome these. And this is what we do as real estate agents, professional real estate agents that educate clients. The first and biggest one, savings for a down payment. I hope I already dispelled that myth by showing you there's ways to get free money from the California government, the San Diego government, city and county, and the US government. There's ways to get free money to make your down payment for you. What am I telling you? You don't need the down payment. You need some savings, yes, for closing costs and home inspections and lenders and stuff like that. But the down payment, we can often get most, if not all of that covered for you if you're a first-time home buyer. A lot of folks also say, number two, I don't know where to begin. 20.8% of folks say, I don't know where to begin. Typically, beginning is sitting down with a real estate agent. If you're interested in buying your first property, second or third, or even an investment, or maybe you want your first property to be a duplex, so you can live in one unit and you can rent the other to help pay down your mortgage. And yes, you can buy a duplex as your first property. The way you get started, where do you begin? You just reach out to me, reach out to my team, and we schedule an initial 60-minute consultation to talk through the next steps, to learn more about you and to set you and your financial self up for success so that you can buy real estate in the near future. I'd like to close it out with this quote. In order to cross the finish line, you must first cross the starting line. I love this quote because I meet so many people that want to cross the finish line, whatever that finish line might be. And in this case, that finish line is owning a house, but they're too afraid to step up and cross the starting line. Don't be afraid. The starting line, buying a house seems scary if you don't work in this industry. Seems scary to me before I worked in this industry. I've worked in this industry long enough now, guys, to know that it is scary when you don't work in it, but as someone who's a professional in it, my job is to educate our clients, to peel back the unknown, to explain what buying property is like, the advantages of it. What is a loan? How does it work? That's the starting line. And the starting line usually starts out by meeting with me, meeting with my team members. What you see in front of me is one of the top teams in the United States of America. Every year we have been ranked locally in San Diego. We've been ranked in California, and we've been ranked nationally in the United States of America as one of the top 1% of all teams in San Diego, top 1% in California, top 1% in the United States of America. And we do this not because we work with multi-million-dollar buyers. We do it because we work with a lot of normal people. People like you, people like me. We all come from similar backgrounds, I find quite often. And our passion is to help first-time home buyers get into housing, to help second-time home buyers make intelligent decisions on how to sell their first home and buy their second. And we also love to help people who want to take the next step and buy investment real estate. If you fit into any of these categories, from a first-time home buyer all the way to an investor, and you want to work with an intelligent team that focuses on educating clients rather than selling clients, then we're the team for you. And I would love to sit down with each and every one of you when the time to make your real estate decision comes. The best way to get a hold of me is my email, which you see in the top right. And I'd also like to encourage you all to check out our YouTube channel. You can simply go to YouTube, type in Kappel Realty Group in the search bar. Once you find that site, click on it, push the like button so you see all the new webinars as they get posted every couple of weeks. But I think you'll really love watching some of the past webinars, the titles which you see here on the side of your screen. You see there's a real estate update for July. Well, you don't have to watch that. You watch this one just now, which will soon be uploaded. But here's the next one. San Diego and California down payment assistance programs. Investing in real estate 101, how to build your wealth. Investing in multifamily properties, 2 to 4 units. House hacking 101, how to live in your home for free. And yes, our team has many clients living in San Diego for free because they're doing what we call house hacking, buying a duplex or buying a house with multiple rooms and renting out a large portion of it to pay their mortgage. With that, I invite you all to check out the YouTube channel. Send me an email if you have any questions, comments, or feedback. And if you'd like to sit down for an initial 60-minute consultation, I'd love to meet with each and every one of you. It's super easy. We usually do it by Zoom, so you can do it from your home, from your office, and we just talk for 60 minutes about what your goals are in real estate and how my team might be able to help you. With that, I'll take a look at any of the questions that might have come up. 1 second, I'll pull out the chat and answer any of these questions that popped up. I see one from Sherry that says, when you say Wall Street investors buy mortgages, do you mean performing banknotes or delinquent mortgages? What type of mortgages do they own, or are you referring to the big banks issuing loans? Most big investors don't want to buy delinquent mortgages. Buying delinquent mortgages means you got to go after and foreclose on someone. You got to deal with courts. You got to deal with lawyers. It's just not a thing that the big money goes after. So when I see Wall Street investors are buying mortgages, I mean institutional investors, BlackRock, pension funds, retirement funds, life insurance companies, Goldman Sachs, huge banks. They will buy big bundles of mortgage. They won't buy just your mortgage. When you buy a house and you get a 30-year fixed mortgage, your mortgage is created by your lender, but as soon as you close escrow and you get the keys in your hand, your lender is usually going to sell your loan on the secondary market. Now, the secondary market is going to buy the loan from your lender, and the secondary market is Wall Street, okay? They're going to buy this loan off your lender, and they're going to buy 10,000 other loans. And they're going to bundle all 10,000 loans into one investment vehicle called a mortgage-backed security. That mortgage-backed security might have hundreds of loans, might have thousands of loans in it. That mortgage-backed security is going to be sold on Wall Street for hundreds of millions, if not billions of dollars. So if you work at Goldman Sachs and you're buying a bundle of mortgages for $2.8 billion, and you think those mortgages are going to last 10 or 20 years, you're pretty happy. But if you think those mortgages are going to get refinanced in the next year or two, you're asking yourself, why am I going to buy $2.8 billion of mortgages bundled together if most of these are going to be refinanced and not even exist in the next couple of years? So you say, well, what would make me buy these as a Wall Street investor? And what would make you buy those instead of a 10-year treasury from the government paying 4%? Is if you can get about a 6, 7, or 8% return on these mortgages. And that's why Wall Street has driven up the price of mortgages, because they know they're not just going to last that long. Sherry, a movie I recommend you watch, and a movie I recommend you all watch to understand mortgage-backed securities and what happens to your mortgage after you buy a house, is The Big Short. Watch The Big Short. And it's a movie about some unethical things that were done during the Great Recession, leading up to the Great Recession, that caused the Great Recession. Things on Wall Street where they were taking these mortgage-backed securities from people that had low credit ratings, and they were tossing them into mortgage-backed securities to people that had high credit ratings and saying that they all had high. It just wasn't true. I see another question here. Is that a 30-year fix? Yeah, whenever I mentioned mortgages today, I was referencing 30-year fixed mortgages. There's all kinds of mortgages you can do. Your imagination is usually the limit when it comes to mortgages, but the 30-year fix is one of the most popular ones in the United States. And I also see, are there particular areas of San Diego that you recommend for investing? Yes, there are. I went over some of them today. And if you want to know more areas that are good to invest in, reach out to me. Really, to be blunt, to become one of our clients, because my team sells more mom and pop investment properties in San Diego than any other team in San Diego. We've sold, like I said, about $500 million in just the last 5 years, about 100 million a year. And because my team is selling so much property in San Diego, about half of our clients are home buyers, and about half of them are mom and pop investors, people like you and I buying duplexes and fourplexes. But because Kappel Realty is the most active mom and pop investment team in San Diego, we tell our clients where to buy, and we tell our clients where to not buy. So if you want me to say, hey, these are good spots to buy, just give me a call, give me an email, and we'll sit down and we'll be your real estate agents, and we'll give you all the advice on where we would recommend buying and not buying. What are my thoughts on bricks for end of year 1124? Cynthia, can you expand a little bit on my thoughts on changes in bricks? I'll be the first to admit I know a lot, but I don't know everything. And I don't know what that question is asking on changes with bricks. So maybe you can emphasize or just shoot me an email, Cynthia. We can chat.
Oh, sure. I can just clarify real quick. On last Friday, there were, I believe, 7 additional countries that made overtures to join BRICS on 1/1, and the oil trading will no longer happen in US dollars as of that date. So I'm sorry, I just figured you were probably tuned in besides San Diego, but we know you're the San Diego guy, that's for sure. So
yeah, and I did hear that the oil was changing from the US dollar. And I spend most of my waking hours studying real estate, and really San Diego real estate. But every morning when I wake up, I talk to my Google alarm clock and I say, hey, Google, play the business news. And that's where I heard them talking about about oil changing from the US dollar. I don't have thoughts on that. I don't have changes on it because I'm not well versed enough in the oil industry and the currency used worldwide for the oil industry for me to speak to that. So rather than misspeak, I've got to say I can't talk about oil in the national.
Got it.
For it. Sorry.
Well, it's just how it's going to affect our entire economy. So no worries. Thank you.
You're welcome. And then I think that was it for questions. So thank you all for joining tonight. I look forward to hopefully working with some of you in the future. And again, I recommend checking out the YouTube channel if you want to tune into any of these webinars that have already been posted. We'll do another one of these market updates in August. Other than that, I hope you all have a good evening and enjoy the rest of your weeks. Thank you for joining tonight.